I'm trying again. That the stream just quit for some reason. I'm not sure why. So I guess I'll start over really quick and discuss the strategy and where I'm at. So I have two goals. First goal, beat the S&P 500 by a significant margin. So S&P returns on average 6% per year. I want to return on average 3 to 4 times that, so 18 to 24% per year is my goal. And secondly, I want to be market neutral. So if the market's going up, market's going down, I don't care, I'm still making money. The second goal is to create a usable Python tool so that anyone can create advanced models for themselves. So I'm coding all of this in Python. I'm generalizing the framework so anyone can do this. You just have to go through and explore things. So first step is isolate a stock universe from the data. I've done that. I'm only using common stocks, ADRs, which are foreign stocks listed on the US stock market, and real estate investment trusts. All of these have fairly similar market dynamics. I'm cutting out penny stocks and low volume stocks, anything that's had a significant crash in the last year. Then I'm using this universe to train a returns model. The returns model is really good, and I'm very confident in it. So I'll go over that in a sec. The next step, now that I have a good returns model, what I'm working on now is getting a portfolio level model to allocate capital based on the output of the returns model and some other variables like volatility, high level variables, treasury rates, etc. So this is the model performance, and here's why I'm confident in it. So I'm looking at a few metrics. First, I'm looking at the information coefficient here. This is performing really well. I'm shooting for 0.01 to 0.02. On average, the information coefficient is 0.0471, which is really good. The standard deviation of so information coefficient is giving the predictive power of the model. Standard deviation of the information coefficient to information ratio, both on a daily and annual basis, and the t-statistic are giving the stability of the model. And all of the metrics, all of my goal metrics, it's blowing them out of the water. So just based on the metrics, this looks really good. For a single model that's trained from 2011 to about 2019, sometime in 2019, it's then validated on 2021 to 2022, and it's testing mid-2023, about May of 23, through current. So these are the results. And one thing to look at, so in addition to all of these metrics being really good, the decile analysis looks really good. So it should be monotonically increasing by decile. So if I divide it up into the lowest 10%, next 10 to 20%, etc., all the way up to the top 10%, 90% and above, it should start out with negative returns because this is a market neutral strategy, so I'm normalizing to the market average. It should start at the lowest and move all the way up to the highest. Each decile should be higher than the previous, and that's what we're seeing here. So it looks good on the metrics. The decile analysis looks really good. The next step was to see how did it perform over time if I do a walk forward analysis. So this is splitting everything into groups of 4 years. Actually, this is a better walk forward analysis here. So I'm starting in 2016. For 2016, I'm saying train on 2011 to 2015, validate, so tune the hyperparameters of the model on 2015, and then test it on 2016. And then for each subsequent year, I'm validating on the previous year and then training using all of the data that's available to me. So you see that the information coefficient never falls below my goal of 0.01. The information coefficient to information ratio on an annual basis never falls below my goal of 0.3. So for all of these reasons, I've concluded this is a really good model. And so since I got this a couple of weeks ago, I've been trying to get a portfolio model which works on this. So this was my first strategy. It looks really good for the drawdown. The worst drawdown was 3%, so that's really great. I could be confident going forward with this model that I'm never gonna, lose over 3%. Also, the 60-day rolling sharp, this looks really good. There's no way to have something that never drops below 0 or always stays above 1. Generally, you want something with above 1 if you're going to implement it. But if you're rolling over the past 60 days, so that's about 3 months in the market, um, it's going to dip below 0 sometimes, but it should stay really positive and it should run up really high. And that's what it's doing. And if you looked at the average, it would be somewhere around 2. So that looks really good. Monthly returns also look really good. There's a lot more positive months than negative, and the magnitude of the positive months tend to be higher than the magnitude of the negative months. So that's great. But then when I look at the cumulative returns, so I'm testing on 2022 to 26, you see it's only giving about 15% returns. So 15% returns over 4 years, 4% per year. That negates my first goal of beating the S&P by a significant margin, because that is on average 6% per year. So I could just buy and hold the S&P and it would outperform the strategy. I tried a simple, I don't even remember what this was, but this isn't working well either. This I thought was working really well, but there was data leakage, so it was looking ahead. So of course it performed great. 20, what's that? 2,000% returns, and that's obviously unrealistic. This I thought was a good portfolio strategy. Oh, this is the same thing. Look ahead bias. Um, yeah, what is? Oh, so I'm back. Yeah, this is all the same model. Okay, so this is getting to something. Oh, so this was a good model, but it works well on 2022 to 26. Um, but you see it's failing these other years. Just a sec, there's some other code I'm running, which is now finished. It took all day to run. I started it this morning at 5 a.m. There was a slight delay because I was on an airplane. But now it's finally finished. So I'm going to put that into my PowerPoint, and I'm not showing that because that's for work. I don't want to show work stuff because I don't want to get in trouble. Open recent. Let me put this in. Sorry, just a sec. This is kind of boring. I can show this because it's not obvious at all what this is. But I need to put this into another PowerPoint. Oh, that's not the best params I need to get. So 170.95. Alright, that's about as good as it got. 0.958. Oh, these are the best params. Good. Okay. Let me paste that in here. Okay, now what I'm going to do, sorry, this is kind of boring, but I have to do something else really quick. It'll just take a second. So where is this? Okay, so I could do that later. Do optimizer, fuse silica, do it on fuse silica. 3e minus 3. Change this to fuse silica. Okay, good. Okay, so back to this. Yeah, basically I'm struggling to get a good model. So let me show real quick. Here's the here's what I need to consider. So this is just running really quick. I already pulled the output of the portfolio in, so it won't take very long. Here are the results. So this looks... Oh, this is starting in 23, so... yeah, so this is a strategy. It looks good. Basically, if there's a big drawdown, it lowers the exposure. If there's high volatility, I lower the exposure. Yeah. And this is the performance. So I'm getting like 2.7x returns on 3 years. Now this looks good if you look at this, but if you look here, I would be at, I would be negative here. Where is this? Beginning of 24. So I would be 7 months into running the model and I'd be negative. So that doesn't look very good. But the total returns are really great. So 250% in 2.5 years. Obviously, that's crazy good. Annual return on average is 40% per year. All of that looks really good. 74 days where it's under 50%. Average daily turnover 26%. So all of that looks pretty good. Let me pull up the code really quick. So this is what I need to think about. How do I make this better? Yeah, I'm not sure. Let me think. But one thing I'm looking at here is the rolling information coefficient. So that's on the right axis. It stays above 0.1 basically the whole time. So 60-day rolling information coefficient, it basically stays above 0.1. So that's really good. But kind of concerning is it's trending down over time. So I need something that will get this to work. Now, what's one thing that's interesting? Oh yeah, I was looking at this optimized model. Not that one, that's fake results. But this is really good results. So the worst drawdown I'm getting is 3%. 2020. Yeah, actually there's no conclusions to make from this. And this one wasn't any good either. So yeah, I'm trying to find a good portfolio strategy. So let me pull this guy up. Claude. But basically these are the results where I'm currently at. So what I'm considering is two different things. You know, do I really need something that performs? Oh, so this is kind of something interesting that I found. If you look at the models over time, so not all of them are perfect, but they tend to be performing really well. And if you're looking at just the bottom decile and the top decile, every time those have the highest magnitude. And bottom decile is negative, top decile is positive. So, you know, theoretically, if I'm trading the bottom and top, I should be really good. Yeah, so one thing is that it's kind of changing value over time. No, but it's still... Yeah, this still should be good. But the market dispersion changes. It becomes a lot more dispersed starting in 2020 with COVID. And so I think this is kind of at the core of what's going on here. So strategy on Model 22 works great. Average annual return 40%. So what did I do here? Because this looks better. But I didn't note down what the strategy I was using was. So I need to do that. So, this guy says I don't want to optimize a strategy. Let's try refreshing. Man, it's hot in here. So that gets really bad, this Sharpe ratio. Um, hey, thanks. Hey, buddy.